let's start with our first topic today. Something I should have covered actually when we started with time series data and cross-sectional data. You remember the distinction that we made? You will not find this distinction in any book written in this precise way. So what was the definition that we gave for time series data? At least one variable for at least 2 periods of time. Okay, so strict definition, because when we, as far as possible, when we give definitions, we should give them in a very precise manner. See, if you give a definition like this, even a computer will understand it. So you have to be always careful when you're talking about things in the world of business. When you're discussing anything related to business, you should try to speak in a manner that is so precise that even a computer will understand. This kind of definition a computer will understand. At least one variable for at least 2 periods of time. But of course, in practice, when we look at time series data, like you look at this cable chart, okay, it is obviously one variable, but it is for many periods of time. Okay. But it fits the definition of at least one variable for at least, that's why I use the word at least, right? For at least 2 periods of time. So even 50,000 periods of time is allowed under at least 2 periods of time. Are you following that? Right? Okay. So that's the definition of time series. And what is cross-sectional data? Yes?
At least 2 variables for at least 1 point of time. At least 2 variables for only 1 point of time. For any 1 point of time.
Yeah, 1 point of time only. You said at least 1 point of time. That's not correct. That means 7 points of time is also and 1 point of time. Then there will be no distinction between time series data and cross-sectional data, right? So you can't have that. So you have to be very, that's why, so you understand now how particular you have to be about the word, use of words. Not, she just added that at least, she said at least 2 variables for at least 1 point of time. But that at least changes the definition, it makes it wrong. Because what, 7 periods of time is also the same as at least 1, it satisfies the rule of at least 1 point of time. But 7 points of time is not cross-sectional data. Cross-sectional data is here. All the bid prices, if you just look at the first column, all the bid prices, and if you take a snapshot now with your phone, this is cross-sectional data. 1 point of time you took a snapshot with your phone, and these are all the prices for all these different variables. So you have at least, what did we say, at least 2 variables. At least 2 variables, okay, so 75,000 variables is also covered by at least 2 variables, okay. So at least 2 variables, but for 1 point of time only. So you can even, like, really poke the computer in the eye and make sure it understands for 1 point of time only, right? Did you shut it properly?
Yes, sir.
You shut it properly, okay. Is this clear to everybody? Basic definitions we are rehashing once again, but you have to be very careful about the use of words, okay? Okay, so something else we should have covered when because I was under so much panic and time pressure at that time, trying to teach you all the stuff for the exam, for the project. So we also have to cover stock concepts and flow concepts. Why? Because whenever I cover any concept, I try as far as possible to cover every other concept that is related to those concepts. Okay. So can you see? Have you guys heard of these terms? Stock concepts and flow concepts. You've heard of it. Chug has heard of it. He's nodding aggressively. What have you heard, Chug?
It was taught in microeconomics. A stock is a concept which means one particular.
Not a stock is a concept. A stock concept.
Stock concept. It means that. So give an example that population is actually a stock concept, but the birth rate and death rate is actually flow concept. What is being added and subtracted to the already existing is flow.
Okay. So if I ask you, and what is the flow concept?
So the birth rate and the death rate are the flow concept.
Birth rate and death rate. Okay. Then if I ask you guys, anybody wants to give another bet? Okay, we don't have so much time today because I have only 2. So the interactive business is there is a real trade-off involved, because if I try to ask people, okay, Vaishali, what do you think? Ritesh, what do you think? But it's maybe more engages the students a little more, but it costs such a lot in terms of time, right? So you have to understand that trade-off. So can you relate? I made one distinction between time series data and cross-sectional data. Can you guys relate? So so I guess most of you have some idea about stock concepts and flow concepts. So can you relate stock concepts and flow concepts, the difference between the two? Because obviously these are mutually exclusive, right? A stock concept can't be a flow concept and vice versa, right? So, and similarly time series data can't be cross-sectional data, right? So can you relate this? This is all in your notes itself, so you don't have to take notes for this because it's all in the file that is shared with you, okay, that you still have access to. All right, now stock concepts and flow concepts, can you relate this distinction to the other distinction that we made about time series data and cross-sectional data? Okay.
Time series data is a flow concept because it goes over a period of time.
Okay, very good. So I will just make some changes to your language because you have actually equated the two. But she's correct. So she's got the right distinction, okay, the right comparison. So it's basically, think about this. So what I'm saying to her is that I would just make some changes to her language and say that they're not the same, but they're similar too. The distinctions are similar. That's why I'm teaching them together. So you've been taught the distinction between time series data and cross-sectional data. So a similar distinction is the one between a stock concept and a flow concept. And so what Behak has correctly pointed out is that a flow concept is more in line with time series data. Is similar to the idea of time series data, because as he gave an example, let me give you some other examples of a flow concept. So let's first give you the theory first. So a flow concept, we'll see how it works. A flow concept is much more like time series data because it's over a period of time kind of concept. And time series data also, as you can see in this chart of cable, you can see that it is from say 21st August to today, right? So it's over a period of time, okay? And when you look at cross-sectional data in our chart of prices, you look at cross-sectional data, whether you look at it like this or you look at it as this way, it's the same thing. Is here we're just highlighting the last few decimals. Same thing, if you take a picture of this at any point of time with your phone, cross-sectional data, because it's a snapshot at a point of time of a whole bunch of variables, okay? So what she's saying is the stock concept is much more like cross-sectional data because it refers to a picture at a point of time, to information at a point of time only. Is everyone clear about this? Have you understood this? We will understand it a little bit better if we now look at some examples, okay? So is this first point clear? First, we are just giving you the theory that first we are telling you that there is a similar distinction between, when you study time series versus cross-sectional, there's another similar distinction that you should be taught, which is stock concept versus flow concept, right? And then we are making a relationship between, we are establishing some relationship between the two. We are saying time series cross-sectional data and stock concepts are similar, and time series data and flow concepts are similar, okay? Now let's look at some examples. What is sales? Now we're talking about, is it a stock concept or a flow concept? Sales. Say I look at IBM, I look at the IBM financials, okay? I won't give you much more of a clue than that. I look at the IBM financial statements and I look at sales. I said $23 billion. Sales is a stock concept, okay? Anybody has a different, everybody is unanimous that IBM sales. Who is saying flow concept? Parul. Yeah, okay, Parul and Shuchi. Yes, Shuchi, why is it a flow concept?
Over a period of time concept, basically, because the financials are declared over a period of time, after a period of time. That's it.
Okay, so you're right about the first part, but your second statement is a bit too strong because financials also include balance sheet, which is not a period of time concept. But anyway, I've given you a hint about the next question. So I should not have corrected the second part of your statement. The second part of your statement is too strong because you're saying that you made a statement saying that financials are declared for a period of time, which means they're only declared for a period of time, which is not true because the balance sheet is not a period of time. But anyway, let me not give you more hints. Okay, next is cash balance. Yes, cash balance. Ritesh, stock concept. Why is it a stock concept? Yes? Why is it a stock concept?
Cash at a particular point of time, that how much cash we use. It is displayed in the balance sheet that is prepared for a particular day.
Okay, correct. So yeah, so he's correct. So it's a cash balance is shown on the balance sheet. So he's making another good connection. Whenever you're talking about these kind of things that appear in financial statements, okay, one good way to categorize them is to immediately think about whether this appears on a P&L or a balance sheet. Okay, so he's correctly pointed out that a balance sheet, so he's made a sequential argument that cash balance appears on a balance sheet and balance sheet is prepared at a point of time. You notice the balance sheet always says as at 31st December.
Yes.
Okay, so it's a snapshot at a point of time. It is not for the fiscal year ended for 31st December. It is as at 31st December. Okay, so balance sheet is a point of time snapshot. Okay, so therefore cash, so it's a good way to answer the question. You made a logical argument. Okay, okay. Next is industrial production. Okay, some are stocking up on flows. Yes, stock concept, flow concept. Yes, Karvit.
Sir, it's a
Industrial production,
flow concept.
flow concept.
Yes.
Why?
Sir, because the industrial production, sir, because the production will be in the will not be at a particular time. It will be between a time span.
Okay, fine. So your language needs improvement, but I understand what you're saying. So industrial production is a kind of report which you see that comes out. I mean, if you look at that Econoday calendar that I showed you guys, okay, from there you'll see even Indian industrial production, Indian economic data is reflected in that global calendar. Okay, so industrial production data will keep coming out from time to time, but it will be for the month of July or for the quarter ended, 30th June. Okay, so industrial production is a kind of information which will be always shown over a period of time, as pertaining to a period of time. It could be 5 years, 1 year, 3 months, whatever. So therefore industrial production is a flow concept. Okay, so it's more like a time series data concept, so it's a flow concept. Then accounts receivable, all the money that Hardik owes you. Yes, yes. Stock concept, why is it a stock concept? Balance sheet, right? Accounts receivable is always shown as the amount that is at a point of time. It's a balance sheet item. Okay, good. So all right, so accounts receivable, we can do this. Okay, so there's another important concept distinction that I wanted to add to the time series cross-sectional data. So you see one example in financial markets. Actually, there are many other important examples of cross-sectional data. We should highlight that, which we are not able to cover at this point of time due to lack of time. And those are things like yield curves, okay, implied volatility, term structure, all those things which you should be aware that our coverage of time series data for charts for financial markets is more or less okay, but our coverage of cross-sectional data charts in financial markets is incomplete, because important things like yield curves, term structure charts for implied volatilities, okay, other types of cross-sectional data charts that we have not had time to cover. We'll hopefully cover it in the next course. Okay, so all that you know about time series data at this point of time is only this, that this is just a snapshot of a bunch of things, a bunch of variables at a point of time. We can close this now. All right, so next we have to go into some very important calculations on trading systems. Okay, you have to understand. Now if you go back to your decision problems, the list of decision problems, as Mehak was pointing out yesterday, we have not covered this adequately. Okay, the number of units, because this is an important decision that you have to take whenever you're trying to trade anything. Like if you want to join me on my cable short and you want to go short, cable, what happened? There should be a pop out. Yeah, so the moment you try to sell cable, what is the system asking you to specify? Units. The system wants to know how many units you want to sell. Okay, so this is not something to be determined arbitrarily, although many even professional traders determine it arbitrarily, but that's wrong. Okay, there should be a structured way to determine it, which is an integral to your risk management approach. Okay, the position size is how you control your risk, really, because the entry and the exit are pretty much determined by the market conditions. Okay, so this is very important. We need to figure out a way to determine this. Okay, so we'll just close this for now. All right. So how do we decide the position size? Now, with respect to this, and also with respect to pretty much to this, and then also the management of profitable positions. Okay, that also requires a lot of planning and a lot of calculations. Okay, as you can see, generally the management of losing positions is not that complicated, because you just put a stop and the market goes through the stop. That's it. That cycle is over and you start again with the new analysis for another trade. But once you have a profitable, if the market is moving in your favor, then there's a lot of things that you have to do, like pyramiding. You have to understand the position size, and there are so many things related to the planning of the trading system, which we are going to cover now. Okay, so let's look at the first concept, which is risk per trade. Okay, now so far I had told you, for the purposes of your project, because we did not have time to cover this in detail, so I gave you a thumb rule saying that you should just use 1%. Okay, so you were supposed to use only 1% of your so this is what I told you here when we were doing the calculations here. I said you take 1% of your annual risk capital, define your risk capital, and for purposes of this project, your risk capital was given to you as $1 million. So you take 1% of $1 million as your risk capital. Okay, so this 1% now, actually that's an arbitrarily determined figure that I gave you, because I wanted it to be a low figure. But there's actually a better way to determine this 1%, whether it should be 1% or 2% or 0.5% or whatever. Okay, so we are now going to come to that. Okay, for that you look at position size. This sheet is already in your folder, so you can access the sheet. So let's look at something which is how are we going to determine the so under system edge itself we can find this. Okay, so let's look at the way you're going to determine this. So let me just give you the theory first. Okay, so the way you determine the risk per trade, okay, which is going to be a dollar amount, it's going to come out as a dollar amount. Okay, the way you determine it is that basically we want to have this approach. Now there's actually no so opposite of deterministic is probabilistic. You guys have done Monte Carlo simulation and all that. I think you'll be doing that with DG Sir in this corporate finance modeling course. Okay? Yeah? You have done before in FM. Okay. So Monte Carlo simulation is a simulation, but simulation gives you, so there are two words you need to know: deterministic and probabilistic. These are opposites. Okay, deterministic and probabilistic. So what I'm trying to say is when you make a probabilistic, so when you're doing things like Monte Carlo simulations, they give you probabilistic outputs, like they give you a probability distribution of outcomes. Okay, so you, in a probability distribution, you don't know that this will happen for certain. You just know that certain events have certain probabilities associated with them. Okay, so that's a probabilistic estimate of what might happen. All right, but a deterministic estimate means if I say that Chandrayaan will lead, our lunar probe will hit the surface of will land on the surface of the moon in 29 days and 13 hours. Okay, now that's a deterministic statement. Okay, that's a precise statement, and because of everything there is quite stable, we don't, suddenly the gravity of the earth does not change. Okay, so therefore everything is predictable, so we can, that's why people are able to predict so precisely when this thing will land and when this thing will reach that surface. Okay, so that's an example of a deterministic forecast, that we are making a precise forecast that it will land exactly 29 days and 13 hours later, etc. Okay, so that's the difference between deterministic and probabilistic. So you should be aware of these terms, that sometimes when you're in a position to make a deterministic with respect to, like, when will the sun rise tomorrow in Delhi, we can say that because we know the speed at which the earth is revolving. Okay, so we can, so those are not, they don't give a probability estimate that the sun will probably rise at 6:30 or, right? They give you a precise time. Okay, so that's a deterministic forecast. Okay, the opposite of that is a probabilistic forecast, where because of the situation, you don't have a very good idea as to exactly what will happen, but you can give some probabilities. Okay, and even those probabilities, in many cases, are very subjective. Okay, in certain cases, probabilities are objective, like when you're looking at a game of cards, what is the probability of getting an ace of spades? Those are more objective because we know the situation. Now suddenly the number of aces will not change in a deck of cards. Okay, but in the case of things like hurricanes and typhoons and all, those are because we don't really know, so those are much more dicey to predict. Okay, but those are all probabilistic predictions. Okay, so is this clear? First, you've learned two terms now: deterministic versus probabilistic. So what we are saying is, as far as the risk per trade is concerned, there is really no deterministic way, okay, to set this. Okay, by this I mean risk per trade. We are trying to determine this risk per trade now. Okay, so there is no deterministic way to set this. Let me just remove this. Opposite of deterministic is probabilistic. So what we do is basically we make the most conservative assumption possible about the run of losing trades. Okay. So what is the meaning of, you understand what we say, what we mean when we say conservative assumption? Most conservative assumption means, in the sense, that which exposes us to the least risk of being wrong. Okay. So the least risk of being wrong. So if I think that it will take, if it is actually true that it will take, say, let's say 10,000 soldiers to retake say Pakistani occupied Kashmir, if you're the army head of the army chief, if you're the army chief, and if you think actually it will take 10,000 soldiers, you would probably estimate that it will take like 18,000 or 20,000 soldiers. So you estimate in excess. Okay, so here that would be a conservative estimate. If we know for a fact that only 10,000 soldiers will be required, but we estimate, we set the number as 20,000. So then we say it's a conservative estimate. This is clear? Okay, so when it comes to losses, we are going to assume more losses. We are going to assume maximum losses. So when it comes to a conservative, so we are going to make the most conservative assumption possible about the run of losing trades. Okay, run of losing trades is nothing but, obviously, just like when you have, I think my computer is hanging. Okay. Okay, so we'll just wait for it to come back. So the most conservative, what is the run of losing trades? The run of losing trades is nothing but, if you do a lot of trades, okay, some of them are going to be winners and some of them are going to be losers. Is that okay? You understand that? Just like when you flip a coin, some will be heads and some will be tails. And a run is actually a term that comes from statistics. Okay, so what we mean by a run, so this is actually a statistical term. There's actually something called a theory of runs, which is again a statistical branch of statistics, which tries to estimate like things like, when you're tossing an unbiased coin, what is the probability that you will get a certain number of heads in a row? So even if the coin is unbiased, you can actually get many heads in a row. That doesn't mean that the coin is biased. Okay, so similarly, run of losing trades, so basically run of losing trades is like this. It means loss, 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 then win. Okay, so we have basically a run of 6 losses. We have a run of 6 losses. Now the distribution of trades can be like this, then you can have a win, then you can have a loss, win, then you can have a loss, then you can have a loss, then you can have a win, then you can again have another run of losses. This can be a run of 13 losses. Okay, so this is what is meant by runs. So the run in statistical parlance, in this context that we are covering right now, a run has a very different connotation from saying I'm running to the canteen. Okay, so it's a different concept of run. Okay, the different use of the word run. So this is what we mean by a run of losing trades. Are you clear about this now? Okay, when we're talking about a run of losing trades, obviously, if you're running a trading system, if you're operating a trading system, you'll be doing many trades. And when you're doing many trades, you are going to later on, when you look at the distribution of trades, it'll be something like this. It may be something different. It may be like 10 losses in a row initially, then 15 winners, then 3 losses, then 5 winners. It'll be some kind of distribution. It could be all kinds of things. Okay, but there will be some distribution. Do you understand that? If you do thousands of trades, Okay, even if you do hundreds of trades, there will be some distribution at the end. You can distribute, look at the sequence of trades, that the first trade was a loser, second was a winner, so on and so forth. So this is what we mean by the run of losing trades. So how do we do that? So far you're following? Okay, we are trying to, there is no deterministic way to be sure, so we are trying to set a very, very conservative estimate so that we are not wrong about we want to find out basically the risk. We want to set a very low risk per trade by making very conservative assumptions. We are going to assume that we are going to lose almost all the time, that kind of approach. And then we'll set the risk per trade so that we don't get surprised on the negative side. Okay, are you following the philosophy here, the approach? Right? Okay, so it's like if you need like 20 crores to start a bakery business, you are going to start it with 60 crores of capital. So maybe you need 20 crores, maybe first 3 years you'll lose 20 crores actually before the business becomes profitable. But in order to be extra conservative, what you're doing is you're starting the business with equity capital of 60 crores. So it's 3 times the amount that you think actually will be required. Okay, so that's what is meant by a conservative approach to risk planning. Okay, all right. So what we do is first we have to project the number of trades. Okay, now that is a function of your understanding of your system. Okay, so this part you don't worry about at this point of time, where we are just going to, because there's an additional way that you can program. Okay, so these are all examples where you're trying to model one variable as a function of other variables. Okay, so these are all examples of the use of models in finance, because even a simple model like y is equal to a plus a plus bx, that is also a model. Okay, it doesn't have to be something highly complicated in the partial differential equation, or those are also models and these are also models. Okay, so we'll do a theory of models later on where we'll look at the fundamentals, but here these are all examples where you're modeling one variable as a function of others. Okay, so first we have to project the number of trades. So let's say that we are projecting for our and this is obviously for a particular period. Okay, this is all for one period. Let's assume it's 1 year. Okay, all of these trading system calculations are all based on some kind of trading horizon. Okay, trading horizon, we use the word trading horizon or trading period. Okay, it's always related. You can do it for a quarter also, you can do it for a month also, but it will be related to some period. Okay, risk capital, when we talk about risk capital, like your risk capital of $1 million was given to you for a period of about 5 weeks. You basically had about 5 weeks. So understand this, that risk capital and investable capital, these are all related to some period, because if you talk about 20-year trading period, the risk capital will have to be bigger than if you're talking about 1 quarter, right? So these are always related to the concept of period. Okay, so all right, so let's look at this. Let me just clarify this also, so that most I'm just writing calc. Okay, this is clear? So for all your trading system calculations, things like trading period, risk capital, investable capital, okay, usually there will be some period attached to it. Okay, so what we are doing is, so I'm not writing the period specially in this. Okay, we're going to say, let's say for this example, this calculation is 1 year. Okay, for 1 year, okay, is let's say we can even write it here. In 1 year, usually we have about 250 trading days, okay, in the financial markets globally. If you're trading in the global foreign exchange markets, we will typically assume 250 trading days, because 52 weeks, Saturday, Sunday markets don't trade. 52 weeks, so that's 104 days gone from 365. So you start with 365 days minus 104, and what you have left roughly with the holidays and everything, it comes to around 250. Okay, so we assume about 250 days. Okay, so for 250 days, I've assumed that you do 2 trades for every day. So therefore, you are going to do 500 trades. Okay, this spreadsheet is all in your folder. You can access this. You can see the formulas later. Just try to follow what is being done. Okay. So why don't you guys come forward, Arora and Pulkit? Why don't you come and sit on the first bench? Come and sit on the first bench. Okay. number of trades, I'm assuming that 250 trading days in a year, I'm going to do 2 trades per day. So my total projected, so these are all projections, okay? These are projections. Therefore, these are what we call ex ante. You understand ex ante versus ex post? Yeah, ex ante, you've done this in legal aspects of business. Ex ante versus ex post. Ex ante is we are I think I've written the definition somewhere else, okay? Ex ante projections, we are doing, most of them are, these are actually ex ante, but I'll see where, let me see this, if I have this. Yeah, okay, system edge I've defined as can be, so I've defined it there, okay? So we are right now doing ex ante calculations, so it can be, the thing can be, these calculations can be either ex ante or ex post, okay? In ex post, you're working at the end of your trading period. If you trade for 1 year, at the end of the trading period, you can go back and look at your performance, and then you can do some actual realized values, okay, that I lost 16%. Now that's an ex post figure, because that's an actual figure of what you lost. But ex ante, you may project that you are going to make 15%. That's an ex ante projection, okay, so therefore it's not certain. All right, so we are right now doing ex ante calculations, trying to determine risk per trade. All right, what are we doing? Number of trades, we are saying, is going to be 500 trades. We are going to be doing 500 trades, okay? At any point of time, if you don't follow, please ask. Okay, 250 trading days, 2 trades per day, 500 trades. Now we are projecting 75% losers, okay? Because we want to show you a very conservative approach. All right? No, in fact, you may not have 75% losers, but you should still work with very high, estimates of losers. Okay. So, for instance, I always use 75% at the beginning of every trading period. Although I've never had 75% losers, but I always assume that I'll have 75% losers. So that's a conservative approach, because you never want to be surprised on the wrong side. See, if you expect to lose $10 million and you lose $5 million, it's okay. But if you expect to lose 3 million and you lose 7 million, that's not okay. They're not the same. You understand that? There's a certain asymmetry in that. So you always expect to lose much more than you think. You should plan to lose that. When you're doing a risk planning, you should make very, very conservative assumptions. This is a conservative approach to trading, which I feel is better, because at least it allows you to, gives you a better chance of survival. Because most of the time what happens with traders is they don't survive. That after 1 or 2 good years, because they're all basically very aggressive, and then after 1 or 2, you can't afford to be really aggressive in the market unless it's going in your favor. So you can do things like pyramiding, which is aggression, but in general, you have to be very, very careful. You have to be very cautious, okay, if you want to survive. Okay, so if you're too aggressive, you have poor risk control, you will get taken out by the market. Sooner or later, you will see most of the funds, after 2 or 3 years, they have a big blowout and then they have to close. Okay, so by making ultra conservative assumptions, you ensure your survival over long periods of time. Okay, so we're going to be very conservative. We're going to assume 75% losers. Okay, so which means number of losing trades is, you can see number of losing trades is percentage losers into number of trades. Okay, so I'm expecting this can eat losers. Okay, so now what I'm going to assume is, here you see that I put in this thing, the blue ones are for user input. I put in this as 100%. Okay, so now now that I have a projection for the total number of losing trades, okay, I could additionally make an assumption. Now we go back to the idea of runs. So you know that some kind of distribution like this is going to happen. You don't know what it's going to actually be, but you know that something like this is going to happen. There'll be some run of losses, there'll be a run of winners, then there'll be another run of losses. Something like this is going to happen. So what you do is you make the most conservative, assuming that your thing is correct. Okay, this is such a conservative assumption about percentage losses that most people will probably not have such a high percentage of losses. Okay, so you assume that your estimate of percentage losses is correct. Okay, so therefore you assume your estimate of number of losses is correct. Okay, number of losing trades. Okay, number losing trades 375 you assume is correct. Now you make the question. Now question is, how are these 375 losers going to be distributed? Is it going to be 6 losses initially, then 2 winners, 1 loss, 1 winner, maybe 25 losses, or is it going to be something else? We are going to make such a conservative assumption that it can't be worse than that. So we make the worst case assumption, okay, most conservative assumption possible, which is basically worst case. Yeah, I said already here, worst case. What I do is what am I doing? Project the number of trades. Number 2, project number of losses, percentage losses. From here you can get number of losses. So from percentage losses, you get number of losses. Is this clear? From number of trades and percentage losses, you get number of losses. Now you stack them all up front. So you are projecting 375 losing trades in total. You assume that your first 375 trades are losers. So can't be worse than that, right? Any other assumption that you make is going to be leaning very much towards a probabilistic estimate, and it may not work out. Okay, it may actually get worse than that. But if you assume all 375 are stacked in the beginning, it can't be worse than that, right? Okay, so then what we do is, then obviously if we know that, let's assume that this instead of 6 losers is 375 losers. Okay, then obviously if our calculations are correct, if our estimates are correct, after the 375 losers, the rest have to be all winners. Okay, so we want to be able to have capital. Remember, we are just trying to determine risk per trade as a function of our risk capital, because nobody, not even Bill Gates, has infinite risk capital. Everybody has a finite risk capital number. So you will have a risk capital number given by your investor. Okay, so you work with that, you take that risk capital number, and then we are going to use it to derive the risk per trade. So therefore now I'm going to make so after 375 losers, everything else will be a winner after that. So I want to have enough capital to be able to survive those 375 losses and still make the next trade, and after that it will be all winners. Okay, are you following my logic? How the situation is visualized, how you make a most conservative assumption. Okay, so therefore how will I derive, because remember what I'm trying to derive is my risk per trade. So what am I going to do for my risk per trade? You notice what am I going to do? I'm going to take, what is my risk capital? Look at something else we have put in. IC is investable capital, okay? Invested capital, or we can make it investable. You remember we made this distinction between you remember at the very beginning we made the distinction between investable capital, which is an ex ante concept, and risk capital. Investable capital is ex ante and invested capital is ex post. So your investor gives you a certain amount of pool of money. Okay, in your case, in your project, we assume that your investable capital is $1 million and your risk capital is also $1 million. Okay, but need not always be the same. Usually it will be the case that, and remember that this is not a distinction that most people in the market think about. Only typically futures traders think about this, but large percentage of the investing universe, even the professional investing universe, does not think actively about risk capital. But it's a very important approach. It's very important to be aware of your risk capital, because that's how your risk-taking ability is defined. It's not defined by your investable capital. Because think about most investors, if you are investing say 100 million rupees in the stock market, if you are saying putting it into the market to play with for 1 year, are you prepared to lose the 100 million rupees full? Most people will say no, right? So there is a concept of risk capital in the concept as distinguished from investable capital. You may have 100 million rupees of disposable liquidity, okay, which is essentially your investable capital, okay, disposable liquidity for purposes of investment, okay, but that does not mean that you're prepared to lose the whole amount. So the risk capital is actually the amount that you're willing to lose and not have a problem, and not like go and shoot yourself or something like that after that. Okay, so it should be something you're willing to lose, and in business there's always losses. When you set up a business, you budget for losses. So this is like a budgeted loss. That's your risk capital. Okay, so you may have 100 million rupees to deploy in the stock market as a investable capital figure, but your risk capital may just be 40 million rupees. That 40 million you're willing to risk as a business risk. That this is okay, 40 million rupees, if I lose, it's not a disaster. Okay, is this clear? So this distinction is very important, but unfortunately even professional investors, many of them don't actually think about it actively, and there are reasons for that. The reason they don't think about it is because customers are not beating up on them, forcing them to think about it. That's why they don't have to think about it, many traditional asset managers, okay? So, but futures traders think about this, but it's very important from the point of view of learning how to invest professionally. You should have this distinction, and you will not find this distinction in any finance textbook also, okay? But it's a very important distinction. Investable capital reflects your liquidity, but risk capital reflects your risk appetite, okay? So therefore risk capital is to be distinguished from investable capital. So we have an investable capital figure in this example of, we have 100 million. Are you happy? Aurora, you want more? 100 million is okay? Okay, good. So we have 100 million of investable capital. But how much are we willing to lose out of that? So we have another 20%. So we have another field for user input. All the user input is in blue, okay, cyan actually. So we have another row for user input, which is percentage of investable capital. Okay, IC is investable capital. So let me just write it here also. Investable capital. So investable versus, let me just write it here. I think I've written it somewhere else in your notes, but anyway, let me just write it once again. Okay, so before that, let's make this, I don't know where, maybe I've written it somewhere. Investable capital, and we have this concept of invested capital. We are making this distinction versus risk cap. Cap is for capital is okay. Everybody understand? Risk cap, very important distinction. Okay, right. Now I've used two words. Investable. Investable is ex ante. Okay, in a sense it's a kind of ex ante concept, and invested is an ex post concept, because see, all we are trying to say here is that investable capital means when the investor gives you a liquidity of $100 million, okay? So the investor transfers $100 million to your account, okay? So that still remains in the money manager's account, the asset manager's account, as $100 million initially just of cash. Out of that 100 million, if you spend $10 million buying shares of Apple, now you have invested $10 million in the shares of Apple. So you had investable capital of 100 million. So when you invest some of that, it becomes invested capital. Now, even that $10 million you have invested to buy shares of Apple doesn't mean that you're willing to lose that entire $10 million. So that is still invested capital in Apple shares, but the actual risk capital may be much less. Okay, so there's still a distinction whether you are talking about investable or you're talking about invested. Invested means past tense. Investable has a sense of kind of future tense, because I'm giving you this money, this is available for investment. So this is, I have, the money manager has investable capital of 100 million. Is this clear? Okay, so this distinction, the more important distinction is between IC and RC. That either invested or investable capital, distinction between that and risk capital. That is the more important one. And within that also, within IC also, you can have investable or invested. That's not so important, but still it's something that you should be aware of. Is this clear? Okay. All right. So we are saying, so we need one more term, so this is how you do your risk planning. Okay. So you need one more. So here I've given you a lot of flexibility to define the stuff. Okay. So, okay, did I mention this? So let me just complete that, I'll come back to that. So I've got one more row to define what is the percentage of IC that is equal to my RC. That is, if I was willing to lose my entire investable capital, then this figure would be 100%. Here I've entered 20%. Okay, so I've said only 20% of my investable capital is risk capital. Okay, so now I'll just come back to this, that going back to the risk. So my risk capital here, because of this 20% is 100 million is IC, so RC is 20 million because I've entered 20%. Okay, all right, now just going back to this percentage of losing trades in the maximum run. Okay, what we are trying to say here is that there will be some run of trades as you are trading, or once you finish trading, you can see there will be some run of trades. And I was just here, I've given some flexibility in terms of programming, where you can enter that is, even though your maximum run, your total number of losing trades is 375, you could be less than 100% conservative. I've shown you the most conservative approach. Okay, but if you wanted to be, if you didn't want to be so conservative, you could have said that, okay, out of my 375 losing trades, the percentage that will occur in the worst possible run of trades. Here the worst possible run of losses, if you look at this distribution, the worst possible run of losses is 6 because the other is only 1. So when you have 2 run, this is basically, you can even call this a run, even 1 item. But here you have a run of 6 losses and you have only 1 here. So the worst possible is 6. Later on, if you do the full distribution of your trades, you may find that there's some higher number, that there is a place where there are like 27 losses in a row. Okay. So if you wanted to, are you following what I'm saying? If you want it to be less than 100% conservative, if you want it to be not so conservative as what I'm recommending, then you could make this little lower. Maybe you could make it 60%. Okay. So then you'll see later on some of the numbers will change, but we are not going to do that for the moment. Okay. We are just going to keep it simple and we are just going to be ultra conservative. Okay. So we are going to assume that the worst case, that if there are going to be 375 losing trades, let's assume that all 375 are stacked up front. Okay, total number of losses, stack them all up front. This is the worst case, and then you have to leave money for one more trade because you should have money to do the next trade, because then from then onwards it's going to be winners, right? So if you look at a lot of research on trading systems, you can have very high number of losses in a trading system, and then after that you can have winners, a run of winners. So if you don't have capital to trade, or sometimes you don't have emotional capital, because trading is a very emotional business, you're losing money immediately. So when somebody has 16, 17 losses in a row, then the 18th time when they're getting a signal, even though the system is giving you a signal to buy, the human being will actually not buy, because he'll think that, oh my god, I've lost money 70, I don't want to lose any more money. And then that 17th trade turns out to be the one that makes a huge amount of money, that would have made a huge amount of money, and then you don't do that. Okay, so therefore discipline is also very important in the psychological aspect. That's why I've asked you to read that book, The Disciplined Trader by Mark Douglas, which you can find online. Actually, you get the PDF online. Very important book. Okay, so are you following what we are doing so far? So here we are just giving you flexibility, but we are going to not, for the purpose of the example, we are assuming that all 375 trades occur. So now how am I going to decide? Remember, the ultimate goal here is to decide the risk per trade. We are going to decide the risk per trade. So what is the risk per trade? I've got $20 million of risk capital. What do I need to ensure? I've got 20 million of risk capital. Yes? What? Chug is not convinced. You're listening. Okay. Good. Because I'm very demanding. I expect to see like real, your face lighting up, or a strong indication of the fact that you have understood. Okay. So I've got $20 million of risk capital, and I'm projecting 375 losing trades in a row. Okay. So I will have I want to have a constant number, one constant number as for dollar risk per trade. How much am I going to risk on each trade? So I've got 375 plus I want to have money left over for one more trade, right? Okay, so therefore what should I do in deriving? Look at these. So I've got this. Look at this row G5. Look at this cell G5, and look at this cell G9. Okay, and in dollar risk per trade, okay, what have I got? Look at the formula here. Okay, G17 is the same as what is G75? Yeah, this is max run of losers from the start, because this is actually connected to this figure 100%. Okay, so that's why the formula takes this, because it allows you the flexibility. But therefore we take it from this 375. You can see the same as number of losing trades. Okay, so this 53 here is G17, which is the total number of losing trades, 375 losing trades, okay, plus 1 is my divisor. So total number of losing trades, I need to have money left for one more trade. So I need to have money for 376 trades if I risk a constant amount per trade. So effectively I'm assuming like 376 losing trades. Okay, then I need to have money for 376 trades. Okay, so is this clear? Are you following the divisor? You understood the divisor? 1 minute. Okay, and what is the what do you call the term? I've forgotten what the term in the numerator is called. Dividend. No, the dividend is the result. Okay, whatever. Okay, so now what is in the numerator here, guys? G9. What is G9? What is 20 million is our? 20 million is our risk capital, right? So we are dividing G9. Maybe I can make this a little smaller so you can see everything, but then people at the back won't be able to see. Can you still see? Parul, can you still see? Okay. Now you can see, okay? So we are dividing our risk capital by 375 plus 1. We are going to have 375 because I need to have money left over for one more trade. Because if I divide by 375, okay, I will get a certain number, okay, and let's say that number is X, okay. So if I divide 20 million by 375 and the quotient is X, and if I risk X per trade, then 375 into X is 20 million. Then I've already blown up my whole risk capital. At the end of my run of losing trades, I've already blown up my entire risk capital. Then I don't have money to place the next bet.
Shouldn't we have the money left for doing 125 trades?
No, because the next trades are all going to be winners. After 375 losers, you don't have any more losers.
Yes, sir.
All are winners. So all you need is that money to do that one winning trade. The one trade after 375.
You don't want best to be lost, that will get profit by doing one transaction.
Yeah, see, when do you need risk capital? We are not talking about investable capital to put up margin or to actually buy the stock if it's a thing. We are talking only about risk capital, which means you need to be able to fund your losses. Now, after 375 losing trades, you don't have to fund losses anymore because there are no more losses. After that, it's all profits. So you just need to have money available to make that next bet, because technically you don't know whether you have whether it's going to be a profit or not. So you should be able to, because you need to be able to justify theoretically, because if you are blown out, see, even though your projection shows that these are all winners after 375, strictly speaking, when you put on the next trade, you need to have the capital in your account to put on that next one trade. Okay, so therefore I've kept that capital, that justification for that justification, I've kept it as 1. Okay, all right. Okay, so is this clear so far, guys? Are you following what we are doing here? Very conservative. Okay, you could also actually, technically you could also put 17, but let's just put D17. But let's assume you need that extra money for that one trade. Okay, the extra justification of the risk capital for one trade. Okay, because here your account balance is also going down. Remember, 375, when you're starting with a run of losers, your account balance is also going down from the starting balance of 1 billion, from a starting balance of 100 million. The starting balance of 100 million, the account balance is going down, right? So from here now, if you start making winners, start having winners, your account balance will also start rising. Okay, so we are just giving this as 1. Okay, but there is a case for what you're saying, that there is a case for making it for another 125 trades also. Okay, you could do that. That will be even more conservative, because then your quotient will be even lower. Your risk per trade will be even lower. Okay. All right. So we are going to do it this way for the moment. Yes.
I want to ask that, have you taken an assumption of 50 days? Because if we subtract 365 days minus 104, it will be 261 days.
Yeah, but we usually have about 10 holidays. That's why I mentioned holidays. You'll have like Christmas. You'll have Christmas, Good Friday. Those kind of trades markets don't operate, because markets are mostly driven by I'm talking about from a global perspective. You can always localize this calculation. Like in Japan there are many holidays. So if you're trading Japanese equities, the number will be even lower than 250, because Japan has almost like 20-25 holidays. They are like India in that respect. Okay, so if you're trading Japanese, so you can localize this. I've given you an example for the international for the global foreign exchange markets, where we assume about 10 or 11 holidays. Okay, so that's what you normally get if you're looking at global holidays like Good Friday. Okay, then Christmas and those kinds of things. Okay, so that's why you have those 10 holidays. So that's why it's 250. Okay, are you clear so far that we want to have money left for one more trade? Okay. So, okay, so for the moment we'll work with this, okay, but Mehak has raised an important point that we should also perhaps, I mean, there is also a case for doing this, but for the moment we'll work with this idea that you have 17 plus 1, okay. So this is our dollar risk per trade. Are you following now? So this is how you derive your dollar risk per trade, and what is it coming out to be as a percentage of? This is another thing that we want to look at. The dollar risk per trade, remember I gave you a figure of 1% earlier? I gave you a figure of 1% earlier. Okay, so we want to put it in a different way. So that figure is now turning out to be 0.27%. So this is actually a better way to calculate your risk capital per trade requirement, okay, rather than a 1% requirement, because it is connected, then it becomes, it's much richer, it's much more well connected to the nature of your trading system. If you have a trading system which does not trade too often, then you'll have a fewer number of trades, then you can put more money on each trade. Okay, so if you put this, let's say you do one only, say 200, if you reduce this, see right now your dollar risk per trade is 53,000 roughly. Okay, if you change this to say 250, obviously it will, you can double it. You can double the dollar risk per trade. Okay, so this is connected to the nature of your trading system, how frequently it trades. Are you following so far? Okay, so we have learned one important thing, how to actually calculate dollar risk per trade as a function of the nature of your trading system, and you're also getting an understanding of what are the aspects of a trading system you need to look at. Yeah.
Dollar risk per trade, for example, it is coming in decimals. How many points take to the decimals part?
No, you can just take the rounded dollar amount. You can just take the rounded dollar amount, okay?
One single share of the portfolio.
No, what do you mean by one single share?
The calculation is for one single share.
No.
That we're investing.
No, it's not a share, it's a trade. We are now calculating dollar risk per trade, and which is actually basically dollar risk per, okay, a risk per, actually what we should clarify, remember when we discussed that, it's actually risk per unique stop loss. Remember when we discussed the aspect of pyramiding on the TCS shares, you are looking at, so it's actually not even risk per trade, it's when we loosely say risk per trade, but what we really mean is risk per unique stop. When you look at, if you remember when we were looking at TCS shares, we were pyramiding, we had a long position, we went long over here, we went long over here, okay, and then it had gone up to this point, and we raised the stop on this one, part of the stop, part of the position, we raised the stop to this point, okay, so 500 shares we had put a stop over here, and then we wanted to buy additional shares here, and then we wanted to put a stop here, okay, for that short-term trading system. You remember all that? Okay, so this would actually not, so this again would have had to follow the risk per trade rules of the short-term trading system. So actually when we say risk per trade, what we really mean is risk per unique stop trigger level, because it is actually not one trade. You see this? You understand what I'm trying to understand? Because the note is already there in your notes. The writing is there in your notes, but understand what it means. The reason I'm saying it's actually not risk per trade per se, strictly speaking, we use it because it's a brief expression, but it's actually risk per unique stop level, because this is the unique stop level. There are actually two trades that will be riding on this unique stop level, because there is a 500 share lot from the previous purchase, and then there is a new lot we are going to buy over here, some number of shares. So there's actually not one trade, there's two trades which are riding on this stop, but the stop is unique. Are you following? That every trading system is defined by a, conceptually like a level of zoom. Like this zoom level is much higher, much more zoomed in than this trading system, the long-term system, which had a stop over here, right? If you look at this from a 60-minute chart, hopefully you can still see that. So this idea should be very clear in your mind, that every trading system is defined by conceptually by a zoom level. So we had, when we bought 1,000 shares of TCS at this point, we bought 500 shares for the long-term system, and we bought 500 shares for the short-term system. So the long-term system was using a big zoom level, which is this high, low, high, low, high, low, high, low, this one. It was not looking at the smaller moves here, the long-term system. That's why the 500 shares on the long-term system, the stop was here. But the 500 shares, the short-term system is looking at stuff like this also. The short-term system is looking at smaller moves. Are you following this? It's more zoomed in, the short-term system. So it's looking at this high, low, high, low, high, low. That's why the stop on the short-term system is here. The long-term system will not use this stop because it does not look so closely at the market. It does not zoom in so much. That's how we define the long-term system. So every system is defined conceptually like according to a zoom level, okay, visually. And every system is defined by a unique stop at any point of time. So here you see at this point of time for the short-term system, the stop was here. So when we say dollar risk per trade, actually what we mean is dollar risk per unique stop level. Because here we were actually using the stop level for 2 trades. The 500 shares which came from the short-term system here, okay, and then the other additional shares, whatever that number was that we were buying here. So it's not really 1 trade, it's 2 trades. But actually we are still using the risk per trade. See the short-term system, just like you got this number right now, 53,000. We derived that 53,000 number. For the short-term system also, you would have to do this calculation for every trading system that you are employing. You could be employing 5 different trading systems, trading in 5 different time frames. Okay, you can see here, just looking at this chart. This is a cable chart. Okay, you can see by looking at this chart how many different time frames, and you can even increase the number of time frames. Straight away from here you can see how many different time frames you can visualize in each for one given market. This here the market is all the same, but the time frames are very different. When you look at this versus when you look at this, the time frame is very, very different. Okay, so you can visualize many time frames, and each trading system should be thought of as operating in one time frame, that is one zoom level. And therefore when you look at this high low distribution, therefore each zoom level will have a unique stop, because we are saying this high has not yet been exceeded by these highs. So this is the highest low from which a new high was made. So the long-term system stop will be here, the short-term system stop will be here, but the zoom level is different. So when we are using the risk per trade figure for the long-term system, for the short-term system, and putting it here, it's actually applicable to 2 trades, one coming from here and one put on over here. So it's actually the risk per unique stop level. Are you following what I'm trying to say? Right? That for each system, every system will have a particular stop at a point of time. It will have only one stop for each system at a point of time, because the system will have a view. In this case, the short-term system view was it's going up. Okay, so therefore it was going to go long, and in that case when you look at it, there will always be one unique stop for every system. Are you following? These things are very important to understand. I think you can understand it visually. If you think about it a little bit, then you'll understand the picture. These are things which are difficult to explain, understand kind of rationally, but more visually, and you get the concept as well. Okay, the unique stop, the idea, this is a very important idea, that every trading system is defined by, if you're trading from a technical perspective, first you can have many trading systems depending on your zoom level. Okay, and then every trading system therefore is defined by a zoom level, and also defined by also will have a unique stop level associated with it at a point of time. Like here, the short-term trading system, when the market was coming here, it had not broken down. When it was coming here, we thought the short-term trading system is also pointing upwards, and therefore the stop for that had to be over here, because that would have destroyed the uptrend, right? So every trading system is defined by a zoom level, and is also basically going to have one unique stop which is associated with that trading system at a point of time. Is this clear? Okay, so risk per trade really means risk per unique trading, risk per unique, what was I saying? Unique stop level. Okay, risk per unique. So this is what I mean. Risk per trade actually means risk per unique stop trigger level. Stop trigger level means every stop order has to have a trigger level. When you place a stop order here, stop sell order, the trigger level is here, roughly 2207, right? Are you following this? You understand what is stop trigger level? Stop trigger level is that parameter. The stop orders have one parameter. That stop trigger level is the parameter. Okay. So here also the stop trigger level, sell stop order, stop trigger level is around 2032. Okay. Is this clear? So therefore, so now, so that's what we mean essentially. That's how you're going to operate the system, right? Basically, once you derive this like this, you've done here. You derived a figure of 106,000 here because there's 250 trades for whatever this trading system is. Now, when you're using this trading system, every time you're putting on a trade against a unique stop, if it's 106,000, okay, if it's 106,000 against this, then you will size the position in such a way that when this stop gets taken out, the gross loss is going to be 106,000. Okay. So another thing that we should emphasize here, which is actually a point with respect to pyramiding. Okay, when we discuss pyramiding, that you should apply this risk per trade. Okay, risk per unique stop level only on a gross basis, not on a net basis. What do I mean by that? We just go to this pyramiding point here. Okay, this is all. Yeah, on the pyramiding positions, the Ross limits like risk per trade. First, understand what I'm saying. It's already there in your notes. You don't have to write this. Loss limits. When we're talking about loss limits, what we are talking about is this. Okay. Loss limits, which is your risk per trade. The loss limit is given by your risk per trade. Okay. That this should apply on a gross basis, not on a net basis. What I mean by that is this. That go back to this example where we bought 1,000 shares of TCS over here. Okay, we bought 1,000 shares, 500 for the long-term system, 500 for the short-term system. Okay, so when the market has already risen to this point, and let's say all this has not happened, we are over here in the market, right? So when we are thinking of putting on additional risk, okay, an additional position to pyramid our positions. So the stop on the 500 shares bought here for the short-term system, the stop is over here, right? Are you following? Okay. So the 500 shares we bought here around 2105, when it gets stopped out at 2208, is it going to lose money or is it going to make money? The 500 shares for the short-term system which we bought at 2105, which will eventually get stopped. There's a trailing stop for that position here, right? We raised the trailing stop here to 2207 or whatever. When that 500 shares for the short-term system bought over here gets stopped out by the trailing stop triggering at this level, is it going to make a profit or a loss? It's a profit because 500 shares I bought at this and I've raised the trailing stop to this level. So now when the trailing stop is triggered, when the trailing, one sec, try to understand what am I talking about. I'm talking about the 500 shares we bought over here for the short-term system. When we first bought it, the stop for both short-term and long-term was over here. But when the market rallied so far, so much higher, we raised the stop for the short-term position to this level. So it's a trailing stop. Remember, you learned about trailing stops yesterday? What? Forgotten?
Yes, sir.
We used the word trailing stop.
Yes, sir.
Yesterday we used the word trailing stop. We learned about trailing stop. This is called a trailing stop because you have raised the stop, it's trailing the market. The Donchian system uses trailing stops, right? We used the word yesterday. This is what happens when you don't pay attention and don't go home and revise. Okay, even stuff that has been taught yesterday, you're looking blank. Trailing stop, it's trailing the market, so it is following the market, okay, but a little bit behind. Okay, so it's a trailing stop. So if I bought it here for 500 shares and I'm going to have a trailing stop triggered at this level, visually obviously I'm going to make money. Even though it's going to trigger the trailing stop, I'm going to make money. That's why we don't call them stop loss orders, we call them stop orders technically, because when every stop order triggers, it does not necessarily mean that there's a loss. In this case, there's actually a profit. You're locking in a profit. Okay, so now the point is that when I say that pyramiding should be done by applying the risk per trade concept on a gross basis. Remember this short-term system, there is some risk per trade number which has come out of this kind of calculation. And let's say it's $106,000. Okay, you've done some kind of calculation for the short-term system. You came out with a risk per trade number. That risk per trade number is a risk per unique stop level for that system. right? So let's say the short-term system, the risk per trade is 106, risk per unique stop level is $106,000, okay? But you already bought 500 shares here and that will get stopped out here, so this will make a profit. So now should you take $106,000 plus the profit that you are making on this lot from here and then decide the extra amount you're going to buy? Are you going to take that risk? Are you following what I'm saying? See, for instance, here when we are talking about this part, let's cover this. If the triggering of trailing stops on earlier put on earlier, okay, or let's make it much earlier to make it clear. Where if the triggering of trading stops on positions put on much earlier, comma here. What am I talking about? On positions put on, I'm talking about this. This position I put on much earlier for 500 shares for the short-term system, okay, 2100 roughly. And this is the trailing stop for that position I put on over here. Okay, now this is the trailing stop. When this stop triggers, there will be a profit on this 500 share lot. Okay, so that profit, let's say that profit is, let's say, will result in a profit of say okay, that X dollar should not be added to the predefined risk per trade. In this case, this is $106,000. For this example that we are discussing, our system has given the calculation they've given us $106,000 as the risk per trade. Okay, so let's say that then we are also going to make X dollars on this amount. We are also going to make X dollars on the triggering of the stop between from here 500 shares bought at this point, stopped out at this point. That will result in a profit of X dollars, let's say. So the point, my point is that when you are talking about what position size we should put on here, so that the total loss when this thing is triggered on both the positions does not exceed my risk per trade, you should not take that calculation on a net basis, you should take it on a gross basis. That means basically what I'm saying is that the profit you're making on this earlier position from here to here, that should not be factored in. Are you following what I'm saying? That you risk, basically you look at your position just, you know, from here, because otherwise what will happen is you will end up taking a bigger position. So see, because if you're, let's say you're allowed to risk only $106,000, okay, on this position, on this stop. So here you will put on a position in a certain way, okay, you will put, let's say that leads to, let's say 5,000 shares. If you are allowed to lose only $106,000 when this stop is triggered and you are trying to buy the number of shares, some number of shares here, you may come up with a number saying 5,000 shares. You can only buy 5,000 shares as 2235 and then have it stopped out at 2204, okay, which let's say that number is 5,000. Are you following? So 2204, 2233, we can do this number calculation here itself. We still have a little bit of time. Okay, let me just make this calculation here so that we are clear. Are you guys following so far? Are you following so far? I'm trying to illustrate what is, you understand what we are trying to do. Let's try and make sure you understand what we are trying to do. We bought 1,000 shares here, half 500 for the long-term system, 500 for the short-term system. Long-term system is still running with a stop here. Short-term system, the market has gone up here. Okay, now we assume that the market is here, 2235. All this stuff has not happened. We assume that it has not happened. So at 2235, I'm wondering, I need to pyramid. How many more shares can I afford to buy without breaking my risk rules, but still be able to pyramid my position. I need to increase my position. The market is moving in my favor. I need to be more aggressive, like a poker player, right? So I can see already that I have 500 shares here. Let's do this calculation here. I have, let's say the stop is 2207. Okay, let's go back to this. I'm going back to the other sheet now. Okay, so I have, let's say, how did we define this? Okay, let's do it one more time ourselves so that we don't have a problem. Okay, so 2207 is our stop. Okay, and 2207, we are just rising. 2207 is our stop, and 2235 is when we are proposing to buy new shares. Okay, so we are proposing to buy at 2235. Okay, and we have another thing which is 2100, and we bought, let's say we bought this as 2100, and we are going to stop at 2207. Okay. Okay, so we bought this as 2100. Okay, so we bought 500 shares. Okay, for 2100. So when we, for this, we are going to, for this 500 share lot, we are going to make a profit of 500 into 2207 minus 2100. Okay, we are going to make this 53,000. Let's assume this is all in dollars. Okay, we are going to make this profit. Okay, and additionally we have, let's say, just $106,000. 106,000 is what we are allowed to lose per trade because of our system calculations. System calculation is saying that stop per unique, risk per unique stop level for the short-term system is $106,000 because of this calculation we did earlier here. Okay, for this calculation, right? Are you following it? From this we
500. We have to change it to 500 because the calculations according to 500.
No, here let's assume 250, doesn't matter. It's just going to make you 100. It's the same thing. I'm just saying, by this process you have derived this. Okay, you can change it to 300 also, you'll get different numbers, but we assume 250 trades in this, and by this process, what I mean is by this process we have derived 106,000. Yes. Okay, so let's say we are applying this 106,000, so which means we are saying that when this stop is triggered, we should not lose more than $106,000. Okay, but this stop is going to be applying to two positions, one from here, from before, for which this is the trailing stop, and the new one we are buying at 2235. The question is, how many shares can we afford to buy at 2235? Okay, so there are two ways to do this calculation. I'll just take 2 minutes and try to finish off, and then we'll maybe start the next class 5 minutes late. Okay, so what we are saying is, are you with me so far? Are you following so far? What is our decision problem? We need to figure out how many shares can we afford to buy without breaking our risk rules at 2235, so that both lots, the 500 shares from here and the new one we buy here, both will be stopped out at this level, and that should not lead to a break of our risk rule of $106,000 in this system, right? Okay, so we can do it in two ways. This 106,000 should be calculated on a gross basis or a net basis. That's what I'm telling you. So the advice I'm giving you is, when pyramiding, you should take this 106,000, the risk per trade. Okay, that's what the language says here. What is the language saying? Loss limits, risk per trade should apply on a gross basis, not on a net basis. Okay, understand the language? Now, what do I mean by that? This is what I mean by that. You could take this 106,000 on a gross basis, or you could take it on a net basis. That is, you could say that, because see, 53,500 profit you are going to make when this stop is triggered. When this stop is triggered on the earlier lot, you are going to make 53,500 profit. So then why not add to the 106,000, which I am anyway able to take a raw risk on 106,000 for this trade, but then I have a profit coming from the earlier position of 53,000. So why not add 53,500 to this? I can add this, and then I can, are you following what I'm saying? Because if I risk 159,000 on this new stop, against this stop, if I take a total risk of 159,000, my actual net loss will still be only 106,000, because my on the new position, when I'm deciding the size of the new position, if I assume that on the new position I can afford to lose 159,000, and I put on the new position in that manner, then I will lose 159,000 on the new position, but on the old position I'll make 553,500. Yes or no? If I decide to size my new position in such a way that I'll lose 159,500, okay, on the new position, on the new lot, which I'm buying at 22.35, okay, then I will lose 159,500 on the new position which I buy, whatever that amount is. Let's say 5,000 shares. I buy 5,000 at 22.35, and that 5,000 comes out of a calculation that I should not lose more than 159,500. So on the new lot on the second lot I lose 159,000, but on the first lot I make 53,500. Yes or no? The first lot I bought at 2,100 and I'm selling at 2207, so I'm making this. So then on a net basis, on the triggering of this stop, I'm losing only 106. Yes or no?
Yes.
Right? But what I'm saying is you should not do it in this way. You should do it, this is the net basis. This is the net basis of calculation of risk per trade, because you're taking the profit of the previous positions and applying it to this one. Okay? So this will result in variable risk per unique stop, which is not good, and then you're not taking some money off the table, you're not protecting your profit. Okay? So therefore this is not the right approach. The right approach, what I'm saying is, should be applied on a gross basis, which means you should calculate what is our decision problem? How many shares can I afford to buy at 22.35? Okay, with this plan. So the answer to that is, this is the stop, 2207. So if I enter at 22.35 and I lose money and I exit at 2207, I'm losing $28, let's assume dollars, per share, and I can afford to lose only $106,000, not $159,000. So I should divide 106 by 28, and that will give me this number, which is what I can afford to. Number of shares I can afford to buy is 3785 actually. With rounded comes to 3786, so it should be under. Are you following what I'm saying?
Yes, sir.
So this is what is meant. So all these things, so you see how complicated it is to manage profitable when the market is moving in your direction, how much work is involved when you have to pivot, you have to think through all these things. These are all decision problems. Technically, I am just telling you, don't do this. Don't do it on a net basis. But you can always say, I mean, who are you to tell me not to do it on a gross net basis? I can decide to do it on net basis. That means you are solving, but this is a decision problem. Are you following that this is a decision problem? How should I do it? Net or gross? Okay? Alright. So today, Garvit has disappeared. Who else has disappeared? Oh, Garvit is here. Normally you sit here, this side is blank. Okay, so 7 minutes. So we are going to start, it was supposed to start at 11:50. I also need to take a break. So we will start this.
11:30.
No, 1 minute, not 11:30. So let's give it like, 22:25.
Yes, sir.
Okay, 11:25. And then you will have 5 minutes, so you can come at 11:30. But let me not give you that leeway. So attendance will be taken at 11:30.
Okay,
But the class will start at 11:30, 11:25. Okay? But please, 1 minute. Guys, please don't make a ruckus in the corridor and disturb the other class.
No, sir.
Be responsible and make sure.
No class going on in the corridor.
First years?
So your session cancelled.
Okay. But still don't make a ruckus.